Hello, and thank you for joining us for our quarterly market update for Q1 2026. As always, I'm joined by Dr. Steve Garth. Steve, thanks for joining us.
Yeah, great to be here, Kim.
And Steve, no secret what we're going to be talking about. We've certainly all been feeling the volatility, mainly at the petrol pumps of late. What can you tell us about the Middle East conflict and all of the things we're seeing in the news?
Yeah, so it is a volatile period, Kim. And normally when markets are volatile, clients don't really feel that unless they're market watchers. But this time, everyone is feeling the effects. It's all got to do with the price of oil. And when you look at the chart here, Kim, you can see that oil has jumped up by around 80% just in a period of a week since the escalation of the Middle East at the end of February. So higher oil prices mean higher energy prices, and that's going to mean higher inflation.
And so what does that really mean then, Steve? How does that play out in the markets?
Yeah, so a good way to look at the way the market thinks about inflation is through bond yields. Now, Kim, no one really cares about bond yields. No one looks at bond yields except bond guys. But when you look at the chart here, you'll see I'm plotting 10-year government bond yield in both Australia and the US. And you can see at the end of the chart how those bond yields have spiked up. That's an expectation about pricing in higher inflation and, guess what, pricing in higher interest rates. It's probably worth saying, Kim, that in that chart you can see while the US has sort of bubbled along much the same for the year, you can see how Australia's yields shot up in the second half of last year. And that's because we had higher than expected inflation. So when the RBA rose rates in February this year and again in March, in fact, that was always predetermined, if you like. So unfortunately for here in Australia, particularly if you've got a mortgage, I think the RBA are going to be in a tight spot at their next meeting in May because inflation's up. We've already got high inflation, so don't be surprised to see another interest rate hike then.
Well, and there's certainly been lots of that commentary on the news, hasn't there? So Steve, then moving over to equity markets, what can you tell us about what kind of an impact they've had? And let's start with Australia.
Yeah, so number one, equity markets don't like an increase in inflation and volatility increases. And the main reason they don't like an increase in inflation is because higher interest rates will probably mean slower growth. The cost of everything is going to go up. And you can see that's had a pretty good year. At the start of the 12-month period was tariffs and it took a hit and came back. Otherwise, a pretty good year, but you can certainly see that it's come off since late February. But in fact, volatility is not that high. And to see that, Kim, when you look at the returns of our stock market, Australia's down minus 1.6% for the quarter. Now, no one likes a negative number in front of their quarterly return, but 1.6 is kind of small. And you look at the 12-month number, Australian market up 11.7%. I mean, that is a great 12-month return. So markets not as bad as you might think they are, and over 12 months, really good.
I think that's such a good point that you make there, Steve, and certainly we're having lots of conversations with our clients at the moment, and I'm often talking with them that if you were to just judge what you would expect your account to look like by what you're hearing on the news, you are probably quite surprised if you look at the impact that it's actually had. So there's certainly a lot of fear out there, but having a look at the actual, account itself and then the information behind it is a sensible thing to do.
Absolutely.
And so, Steve, you've just talked us through how Australia is actually performing quite well for the 12-month period. What about the international markets?
Similarly, Kim, when you look at the chart here, on the left-hand side, we've got the developed market index. It's down minus 6%, up 6% for the year. Next one is the US, which is the major part of that developed market index. They've had the worst hit, they're down minus 7%. But then other big markets like Japan and Europe, different in different markets, not that bad. And when you go to the far right of that chart, I've got the emerging markets down by minus 2.8. Again, that's not a big drop, but up 17.9% for the 12 month. So that really speaks into the power of being diversified across all markets.
Absolutely, and it's always great to have these insights, Steve, but I think we always wrap up with talking through the importance of maintaining a disciplined approach, maintaining a diversified portfolio, and taking a deep breath. but it's great to understand the metrics behind it and see that, we don't need to just take what the news is saying verbatim. If anyone does have any questions or are concerned, please reach out to your advisor and we'd be happy to take you through it. Steve, thanks for joining us and we look forward to next quarter.
Yeah, terrific. Thanks, Kim.